Good afternoon, everyone, and welcome to our webinar to discuss and just go through the details really of the second round of discussions that have been held with the private bondholders. This is an alert in terms of what exactly is in the proposal that the ad hoc bondholders group has put forward and how the outflows going forward also look like. So just to kind of try to make sense of all the numbers and all the information that we have available up to now and how different it is from the proposal that was put forward in April. So we will go through this short presentation and then we'll follow it up with a concise Q&A in terms of questions related to this debt restructure. So to start off with, in terms of the baseline scenario that the bondholders have put forward, they proposed a 28% haircut in terms of the principals on the existing bonds. That is the outstanding $12.5 billion worth of bonds. They proposed a 28% principal haircut on that. And in addition, in terms of the past due interest, which is essentially since the date that we defaulted, there was an interest that has been accruing since then for the past 2 years of an outstanding 1.9 billion or so. On that, they are providing an 11% haircut on principal front. So this is a slight difference to the proposal that they put forward in April, in which they did not include a principal haircut on the past due interest component. In terms of the coupon reduction, there is about a 25% overall coupon reduction based on our calculations. And this is taken into account the entire period. There's a couple of numbers mentioned within the proposal, which talks about average coupon post 2028, but this is taking into account the entire timeline from now until 2038. And this is as a result of existing the prior to restructure coupons being averaged at 6.8% on a weighted basis versus now at about 5.1% based on this baseline scenario. Of course, the structure of it is definitely a step-up coupon structure, which is what was anticipated, and there's a difference in treatment up to 2027, from 2028 to 2032, as well as 2033 onwards. In terms of maturity side of things, there is a 5-year maturity extension that has been proposed. So payments on the existing bonds will only start in March 2029 going forward and up to 2038. And overall, based on our calculations, this brings us to a baseline scenario of 52% in terms of an overall NPV reduction. And this is assuming a 12% exit yield that we have assumed within this based on the discount rates that have been provided by international banks, as well as other credit ratings of countries within the BB plus CCC rating scenarios. So in terms of understanding when the repayments actually start, so initially there is a consent fee that will have to be paid by the government, which amounts to about 255 million, which is 1.8% of the original claim. So this is due almost immediately as the external debt restructure is completely finalized. This is the entire process. Once it is finalized, they will have to pay this $255 million. In addition to that, the first payment in terms of the past due interest, which there are payments for about 5 years, the first installment comes due this September, which is about 291 million based on the proposal that was put forward. In addition to this, they will also have to pay coupon payments on all outstanding new ISB bonds. So this will also fall due in September 2024. So putting all three of those together, by September 2024, we're looking at about 724 million in terms of overall FX outflows that we will be seeing in terms of payments that will need to be made to overall private bondholders. This is excluding any bilateral interest and so on, up to the disclosure of the agreements that they have made with the official creditor committee. So this is just in terms of the 2024 payments. Going forward from that, from 2025 onwards, principal payments will be due March of each year. So from March of 2025, we will see principal payments falling due each year, while the coupon payments will be paid biannually, similar to the structures that they've had before. So this is likely going to be March and September of each year annually until the last maturity that we would see. So putting all of it together, and again, we're talking here only about the baseline scenario. You're looking at, this is the kind of payment structure you're looking at purely for the international sovereign bonds. So once again, this does not include any bilateral or multilateral payments and purely is the international sovereign bonds component alone. So you can see that from 2025 to about 2028, we're averaging at about $720 to $750 million overall. And thereafter, there is a step up in the coupon that comes into play. And also the maturities that you see start coming in from the existing bonds. And as a result of that, you're looking at outflows or payments rather of over 1 billion that comes up within the period from that point onwards. So just to, in terms of the overall statement that has been provided, this is essentially the second round of discussions that have been concluded. There is an idea that this is a preliminary deal that has been reached between the government as well as the bondholders, but there are a few more steps that need to be completed in order to actually sign off on this entire agreement. So firstly, this working framework it is required to be signed off by the secretary of the official creditor committee. So this official creditor committee essentially includes the Paris Club as well as other bilateral creditors. So this is essentially to ensure that there is comparability of treatment across the creditors. So we know that in terms of debt restructuring, typically you're looking at it being equitable in terms of the haircuts and the NPV losses that different creditors do take. So as a result of that, this will be put forward to the secretary of the official creditor committee to sign off on it as well. Similarly, it will also be required to be reviewed by the IMF staff. So this is essentially to make sure that given the haircuts that have been proposed in addition to the other macro-linked bonds and so on, to ensure that they would be able to reach the debt sustainability targets that have been laid out within the IMF program. So this is essentially the three debt targets which are related to reaching 95% of debt to GDP by 2032, 13% average GFN from 2027 to 2032, as well as having external debt service payments being less than 4.5% of GDP. So these are the three debt targets that had been outlined in the IMF program. So they will review to assess whether these targets can also be met, taking into account the proposal that has been put forward by the ad hoc bondholders, plus also looking at the bilateral debt restructure that has been put in place as well. Whether all of these things combined can allow Sri Lanka to actually reach those debt targets that have been laid out. So there are a few more steps in terms of actually finalization and signing off of this deal, but this is the proposal that has been currently agreed upon between the government as well as the ad hoc bondholders group. So one thing that has been interesting within within the structure is the macro-linked bonds component. So what we're seeing is that there are almost no other countries that have actually seen this type of agreement being put in place. And this is of the view that Sri Lanka can actually overachieve a lot of the IMF targets that have been, or IMF projections that have been laid out. And as a result of that is why they have chosen to go ahead with the macro-linked bonds based on the Treasury statements. But there's a difference in terms of the criteria for assessing the macro-linked bonds. So when we were looking at the April proposal that was put forward by the bondholders, the only criteria that they were assessing on was in terms of nominal GDP that was USD based for the period from 2025 to 2027. So they were purely going to look at the average of nominal GDP in USD terms for that period in terms of determining what thresholds Sri Lanka would fall into in terms of the macro-linked bonds and how that then translates into the different types of haircuts and reductions in terms of overall NPV losses as well. The difference this time in the current proposal is that they have a second assessment criteria, which is more of a control variable. And this we'll see is part of what the government actually put forward in its March proposal, which was also to include a real GDP growth kind of test variable. So here you can see a control variable, which essentially says that you have to reach above 11%, 11.1% in terms of cumulative real GDP growth from 2024 to 2027 in order to actually trigger the macro-linked bonds, in addition to the US-based nominal GDP, also achieving the different criteria that they have mentioned. So there are two controls, two test criteria essentially in place right now versus the one that was there before. In terms of the overall number of bonds that are included as macro-linked bonds, the government's proposal previously in March was that they adjusted to 3 macro-linked bonds, whereas the creditor's proposal was that they stick to 8 macro-linked bonds within the whole restructure. This we see is unchanged from last time, and that they have agreed to go ahead with 8 macro-linked bonds rather than the 3 that had been proposed by the central bank. So in terms of the different types of haircuts as well as the coupon changes that you would see as a result of Sri Lanka actually triggering some of these criteria is as follows. So for example, if you're looking at the IMF baseline situation, that row over there, you can see that if Sri Lanka achieves a nominal GDP in USD billion terms of 88.6, in addition to, as I mentioned, the cumulative 11.1% of real GDP growth from 2024 to 2027, this essentially, just in the baseline scenario, this is not assessed. It means a 28% haircut in terms of the overall existing bonds. And as a result of that, you will see post-2028 coupons being 6.3%. So this is not the macro-linked bond, but essentially in the baseline scenario, right? But what we will see is that, for example, if Sri Lanka is able to achieve a nominal GDP growth of 92 billion between 2025 to 2027, in addition to actually exceeding the 11.1% cumulative real GDP growth, the principal haircut undertaken by bondholders will reduce from 28% to 20%. And the coupon that Sri Lanka would need to pay on these bonds will increase from 6.3% to 6.6%. Similarly, the structures are there in terms of the higher levels as well. So in the highest level, we see the threshold is if Sri Lanka achieves a nominal GDP of $100 billion within that average period of 2025 to 2027, the principal haircut then reduces to 15%, with the average coupon being increased to 8.2% post 2028. So similarly, there are downside scenarios as well. So Sri Lanka underperforms in terms of GDP as well as GDP growth during that period. The haircuts on bondholders can be higher. So at the highest scenario, we can see that they will have to take a 40% haircut. And this is if Sri Lanka achieves GDP of 84.7 billion, while also cumulatively the real GDP growth will be below 11.1%. There is no adjustment in terms of the overall coupons under these scenarios. So looking at all of those scenarios, so we have the payment structure that has been laid out again in the proposal by the ad hoc bondholders here again. And what you can see is if the macro-linked bonds are triggered, the repayments that Sri Lanka will have to make substantially look much higher. And particularly in the period post 2028, 2029 onwards. So for the next 3 to 4 years after 2027, there is no change, but it gets triggered after 2028. And it can substantially increase based on which criteria are actually triggered within the criteria that they have mentioned. One consideration that we are looking at is that in terms of the baseline GDP that they have provided, it is 88.6 billion for the 2025 to 2027 period. And we're looking at 2023, in which GDP, the nominal GDP in USD terms was actually 84.4 billion. So we saw that they actually increased that baseline GDP number. But what we're seeing is that at current rates, assuming Sri Lanka has a nominal GDP growth in LKR terms of 6%, and considering an exchange rate of about 310 average for the year, you're looking at 2024 having a nominal GDP of about 94 billion. So this is already in excess of the baseline scenario that that they lay out in terms of the macro-linked bonds. This is one consideration that we're looking at over here. And in addition to that, we're looking at the period from 2025 to 2027. We've factored in here an 8% nominal growth in GDP in LKR terms, and again, about 5% annual depreciation that we undertake. Just using these kind of assumptions, what we see is that Sri Lanka would average in terms of nominal GDP at about $100 billion, which is essentially the highest threshold that you would see within the macro-linked bond. So these are a couple of the points that we would want to raise in terms of the macro-linked bonds and how that plays out in terms of the different thresholds that have been put forward. Of course, if Sri Lanka does see growth that is less than this, we will not need to move up thresholds, but these are the considerations that we need to make at this point. So in terms of real GDP growth, what we see is that the threshold is at 11.1% cumulatively from 2024 to 2027. So a simple calculation on this is essentially to see that if Sri Lanka sees real GDP growth above 2.67% over this period from 2024 to 2027, essentially the upside scenarios will be triggered. So you can see that this 11.1% is based off of IMF estimates that they have included. And we can see in terms of the IMF projections for GDP growth that they have mentioned within the second review that was provided. They are expecting 2% growth, which is, I think, which is a little bit below what CAL estimates at 4%. But if you're looking at this kind of scenario of growth being at these kind of levels, then it is not a concern in terms of having to kind of move up or down any thresholds. So in terms of the NPV loss that we have calculated over here, and as I mentioned, this is CAL's estimate in terms of what the NPV loss would look like, assuming a 12% exit yield. Under the baseline scenario, we are looking at a 52% NPV loss. At the highest threshold on GDP, we are looking at about a 38% overall NPV loss. And if, for example, if Sri Lanka goes below this kind of GDP threshold, you're looking at bondholders actually taking about a 58% overall NPV loss. So in addition to the macro-linked bonds, there is also a governance-linked bond, which is also on the cards. And this, they have said, is one that they would have to come into agreement with the government as well as the bondholder group. And these are for the plain vanilla bonds. So this is essentially that if Sri Lanka does kind of achieve a couple of governance-linked targets. So last time in terms of the April proposal, the couple of ones that they had kind of mentioned was that there would be one quantitative target as well as one qualitative target. So the quantitative target that they had mentioned was in terms of Sri Lanka possibly achieving the IMF's target on tax revenue to GDP for 2026 as well as 2027. And also the qualitative targets, which are yet to be kind of announced. They are relatively vague in terms of what might be included within that. But if they do achieve both of those, there could be a step down in terms of coupons of about 50 basis points if both of these targets are met. And these are purely for the plain vanilla bonds. So this is also one area in which we would need a little bit more clarity that they would be able to provide once they have completed discussions and closing on the finalization of this entire bond deal. So looking at putting it all together in terms of the reserve as well as currency impact that we would want to kind of highlight, there is a payment of $724 million that will need to be made by September of this year. This is, as I mentioned, including the consent fee as well as the debt servicing payments that would need to be made of about $499 million, which is due in September. So this starting to come due from this second half of this year onwards. essentially means that there is going to be some pressure that builds up a little bit in terms of the overall balance of payments. And as a result of that, the reserve accumulation that the central bank has been able to do over the past couple of months may start to slow down. So it becomes slightly harder for them to actually achieve some of the targets that the IMF has laid out. So, for example, they need to achieve about 5.6 billion in gross reserves by end of 2024, and taking into account the 700 million in terms of these debt repayments plus additional repayments of about 500 million, which we estimate based on, for example, certain multilateral payments and so on. The reserve accumulation overall would have to be about 1.4 billion from June to December of this year. This is doable, is what we believe, but there might be a slowdown in terms of the pace of purchases, particularly that we have seen in the first half of the year that the central bank has been doing in terms of shoring up its reserves. And as a result of that, there could be some level of currency pressure that builds up, particularly given that we have to make this large payment by September of this year. Also, just to clarify, there are no further payments in terms of ISBs for the rest of this year apart from the September payment. The next payment will be in March, as I mentioned, in terms of the principal as well as the coupon payments. So that is essentially to explain in terms of the overall deal on the international sovereign bond holders front. But in terms of bilateral creditors and the agreement that has been talked about over the past week, one thing to keep in mind is there is no principal haircut on this agreement, but there is a reduction of coupon, and it has been reduced to 2.1% based on the president's statement. And there is about an maturity extension of about 4 years, with repayments beginning from 2028. So the fact that bilateral creditors have not seen a principal haircut is not an unusual situation. What you do see is typically in countries that have seen debt restructure, and particularly including the Paris Club and so on, is that they don't usually take a principal haircut. And typically the NPV losses are lower than what ISB holders tend to take. So this kind of difference in terms of the overall structure between bilateral as well as private bond holders is relatively similar to what other countries have seen in past debt restructuring situations. So this is not an uncommon thing. So those are the main areas that we would want to highlight, and just to kind of talk through the inner workings of the overall debt-free structure. We'd be happy to take some questions in terms of clarifying any doubts that anyone has in terms of this deal. There's a question about when the consent fee will need to be paid, whether it will be immediately or with the first principal payment. It all really depends on the timing of the finalization of the external debt-free structure. So it is essentially an upfront payment made at the point of finalizing the debt restructure. So if you do finalize it, for example, around September, then that's when the payment would likely be made. But if we are able to finalize it, for example, within this month, they might make it ahead of time. There's also a question with regards to when Sri Lanka will get access to international markets again, and when we'll be able to raise sovereign bonds again. So in this kind of scenario, what the IMF is expecting, and particularly what the IMF has projected within its second review, is that Sri Lanka would be able to access international markets once again in 2027. So they've assumed that we would raise about 1.5 billion, but this is all based on projections that the IMF has made. So that is essentially when they believe that Sri Lanka will be able to access international markets once again. There's also a question with regard to the timings for the ratings upgrade for Sri Lanka. So based on the industry, in terms of the finalization of the external debt restructure, once it is completed, Sri Lanka should be taken out of its current restricted default status, although rating would not be restored back to the kind of BB levels that we were at before, but it might most likely get restored to about the CCC ratings based on the current situation and improvements made from that point onwards. But if you're looking at a timeline, I would say by about the fourth quarter of this year, it's likely that we might see some kind of rating upgrade, or at least being taken off the overall default list as soon as the debt restructure is finalized. There's a question in terms of whether there has been anything mentioned with regard to converting to an LKR option. This is not something that has been made public, if there is, and it does not look like it is on the cards compared to, for example, when the sovereign, the SLDBs were being restructured, in which there was a lot more clarity with options being put forward for taking it in LKR terms. For the ISBs, this is not something that we have that we would be expecting right now, based on how much discussions have progressed so far. So in terms of what is left to be restructured, so essentially our discussions with the bilateral, so there were two components in terms of the domestic debt restructure as well as the external debt restructure. As you know, the domestic debt restructure was finalized last year. So what is left is in terms of the external debt restructure, which is on the bilateral side, talking to the Paris Club, as well as bilateral creditors that are outside the Paris Club, such as China and India. What we understand from the agreement last week is that all of them have agreed to a similar kind of deal, which is a structure that I've mentioned over here within this slide. So what was left, what was outstanding, was the 12.5 billion in terms of overall ISB debt that needed to be restructured. And this is where we are at right now in terms of the overall discussion, and there would be no discussions with multilaterals in terms of any debt restructure on that end. So there's a question in terms of how much provisions banks have made. So essentially, most of the banks have provided up to 52 to 55%. Some banks provided slightly more than that. But what we understand is that this is the kind of scenario that banks were estimating in terms of the overall NPV loss, which was essentially a 5-year maturity extension, close to a 30% haircut in terms of the principal side of things, as well as a reduction in coupon. So this is, I think, very much in line with the expectations of the industry, which is why the banks were asked to kind of take on such provisions. And we believe that pretty much all the listed licensed banks at least have taken substantial provisioning that would be sufficient for this current haircut. However, of course, there are questions as to what happens once the macro-linked bonds actually start kicking in. This is an area that we are also yet to kind of see a little bit more clarity, because there is no precedence for this kind of thing. Whether they will structure it as a derivative going forward is something that is unknown at the moment, and we would also be looking for clarity, and we would be able to provide clarity once that's available on that front. So in terms of projections on exchange rate based on the repayments that would need to be made, and any idea on the total repayment of the bilateral as well as multilateral debt. So at the moment, in terms of the bilateral agreements, it is a bit unclear in terms of when the interest payments will start falling due. We do know that in terms of principal repayments, that they will be starting after 2028, but there is not as much clarity in terms of the interest side of things, whether they will be also being made from this year onwards, or whether that will also be provided a grace period up until 2028. But multilateral outflows have continued, on multilateral interest payments and so on have continued to be made and has not halted. So that we will be expecting to continue without too much added pressure on the currency. So what really adds pressure right now is the 724 million in terms of ISB payments that need to be made. So there is a little bit of currency pressure that we would be expecting. But overall, this has been largely factored into our models, and we do expect the currency to depreciate between 310 to 320. And based on the numbers that have been put forward, it could possibly be in the higher end of this range at the moment, given that we have finalized it slightly ahead of CAL's expectations. So in terms of the benefits after restructuring the bond, essentially what this helps for is really in terms of going forward with an overall IMF program, because coming to an agreement in terms of the overall external debt restructure was one of the prerequisites of the second tranche of the IMF. And now that we are kind of closing in upon signing the MOUs and so on, this would allow them to release the second tranche in terms of the IMF agreements. But also overall, it essentially means that we have a reduction in terms of our overall debt position, which allows us, and we also have a reduction in terms of interest payments going forward, which essentially puts us within, would ideally put us within the IMF's debt sustainability framework, give us access to foreign sources of funding once again. We're also looking at bilateral partners, for example, relooking at reinitiating projects and so on in Sri Lanka, given that these agreements have been finalized upon. So we do think that there is sizable benefits to come in from the fact that there's a finalization of this overall debt restructure. So in terms of the question on what steps should a government take to reduce the GFN and debt to GDP ratio, so undertaking this kind of restructure is definitely one part of it. So our GFN has come off quite a lot since the domestic debt restructure has been completed, and that is the bringing down the GFN is very much more of a domestic debt management perspective, whereas the overall debt to GDP is much more affected by external debt, by the external debt restructure. So going forward, I think the main steps are basically to ensure that we are able to have sufficient GDP growth to ensure that our base is growing at a sufficient rate, and also making sure that we are not building upon by taking on additional debt, that our interest costs are kept under control. And as a result of that, there is no added pressure in terms of the overall gross financing needs or the overall debt to GDP, and increasing that beyond the projections that are currently put in place. I think broadly, most of the questions have been covered. I think in terms of the questions in terms of how much banks have provisioned, once again, it's essentially between 52 to 55%, which is adequate based on the NPV calculations that we have based it on, which is on a 12% exit yield, which other countries of similar credit ratings tend to kind of use. So at the moment, we do believe that there is sufficient provisioning that has been undertaken, and they would not need to do any more provisions as a result of this. But post 2028, as I mentioned, because of the macro link component, there could be differences, which at the moment are not yet kind of disclosed in terms of how banks will have to account for it, or how overall ISB holders will have to account for it as well. So that could change things in the future. But for right now, we believe there's sufficient provisioning that banks have already undertaken. And as a result, there shouldn't be further need for impairments on this front. I think that broadly covers all of the questions that have been put forward within the Q&A. Thank you very much for joining our session. We just wanted to kind of really provide a little bit of detail and color into this agreement, because we understand it is quite complex, although it is so important in terms of Sri Lanka actually moving forward in terms of the IMF agreements, and also reaching the targets that have been mentioned by the IMF in terms of the debt sustainability side as well. So this is just to provide clarity on it. I believe we will find out the finalization details over the coming weeks, and we would expect to be able to provide an update based on that thereafter. Thank you very much for joining.